This is Brad Harvey of Harvey Investment Management. Today we're going to give an overview of the third quarter and year-to-date performance in the investment markets. Overall, it's been a very challenging year. We've had 3 consecutive quarters of pretty poor performance. Historically speaking, that's relatively rare, and many of the investments out there are 25% off of where they were at the beginning of the year, let alone from their highs, and maybe even much more. To run down the numbers for you, the Dow Jones Industrial Average in the third quarter was down 6.66%, taking the index down for all of 2022 of just under 21%. The S&P 500 did a little better in the third quarter by only being down 5.36%. However, year-to-date, they're down 24.8%. The NASDAQ 100, which is tech-heavy, in the third quarter was down 465, however, year-to-date, down just under 33%. Small caps really aren't much better. In the third quarter, they were down 4.67, and year-to-date, they're down just over 25%. Foreign markets haven't done any better either. In the third quarter, the Large Cap International Index, EFA, was down 10.37%, and year-to-date, it's down a little over 28%. And the Small Cap Foreign, also known as emerging markets, in the third quarter down 13% and year-to-date down 28%. So that kind of sums up how the stock market was, which is not pretty. The bond market has fared not much better, or in many cases, a lot worse. The 10-year Treasury yield, which is a bellwether, a lot of loans are based on the 10-year yield, at the beginning of the year was 1.51%. At the end of the year, it went all the way up, or in the end of the third quarter, to 3.804. That is a 151% increase in the 10-year yield. I don't have to tell you, if you're a long-term bond holder, you have seen your asset values erode rather substantially year-to-date with the rising interest rate environment. You might want to reevaluate that and shorten up some of your maturities, or look at variable rate bonds, or ride out the storm. Commodities, which have done a little better, usually price in with inflation. Inflation certainly has been a big number this year. We don't know the numbers from September yet. We'll get those in another 3 or 4 weeks. But year to date, the commodities, the broad commodities index, is up 14.5%. However, keep in mind that in the third quarter, it was down 10.25. Gold for the third quarter was down 8.19%, and year to date, it's down 9.53. So gold not keeping value, certainly not versus inflation, as it historically has. Oil, which certainly was a stalwart in the first 6 months of the year, in the third quarter lost 26%, bringing its year-to-date total positive 6%. Another interesting thing to note in all of this is the US dollar value. The US dollar, as measured against other major currencies, is up for the year 17.28%. This is particularly true against the euro and against the British pound sterling. What does this really mean? Well, from an investment standpoint, it certainly has been a rough year. However, it could be behind us, the worst. It could be in front of us. We shall see. Time will tell. Markets do recover. Sometimes they take a long time. Sometimes they take a very short time. But regardless, we're 9 months into this at least, if not 10. If you look at the dollar changes, those are a little more rare. I personally think that the dollar has been going up in value versus foreign currencies, mostly because we are raising interest rates and the rest of the world really hasn't been following, certainly not lockstep. So that has made our dollar relatively more valuable. What that means from a practical standpoint is that foreign travel is cheaper for US dollar-denominated consumers, and it's more expensive for non-dollar denominated consumers. So foreign travelers may not be coming to the US in the same numbers, or when they do, they may not be spending as much because of the conversion rates. Further, it means that foreign goods are cheaper on a relative basis than they were at the beginning of the year when you look at dollar terms. Also, countries that make a lot of money in non-dollar assets might have to reprice their earnings based on the strength of the dollar when they repatriate back to their U.S. financial statements. Keep in mind that a strong dollar can also help to ease some of the supply problems, because foreign suppliers might be more interested in selling their goods to U.S. consumers on a dollar-denominated basis. However, it can hurt U.S. manufacturing. Therefore, a strong dollar will likely cause a significant increase in our trade deficit. So this is Brad Harvey with Harvey Investment Management. I hope that was helpful. This is our Q3 overview for 2022. Thank you.